China didn't just lose an investment in Venezuela, it watched a decade-long geopolitical bet evaporate in real time. And the number you need to remember is $106 billion. Not because it's the exact accounting figure, but because it represents total exposure. Loans, oil for credit deals, infrastructure, joint ventures, political leverage, all built on one assumption: that Venezuela would remain stable enough to pay. That assumption just broke. This is money and empires, and today's story is bigger than Venezuela. It's a repeatable pattern that has shattered empires for 200 years. Here is the hook. When a rising power tries to build influence inside a dominant power, in its backyard, the collateral becomes political, and political collateral can vanish overnight. China backed Venezuela for energy security and strategic positioning. The United States saw it as a sphere of influence intrusion. And when spheres collide, the spreadsheets don't matter anymore. What makes this case explosive is speed. You had years of capital, contracts, and pipelines built into one direction, and then a single disruption flips the board. Now China is left with oil shipments at discounts, projects at risk of renegotiation, and partnerships that can be erased by a new regime. But don't get distracted by the drama. The real story is the structure. The same structure has repeated through history with brutal consistency. It doesn't require the same leaders, the same ideology, or the same century. It only requires 4 ingredients: a creditor with ambition, a debtor with instability, a strategic resource narrative, and a hegemon with proximity. Once those ingredients are present, the cycle tends to run the same way. In this video, I'm going to show you the 4-stage pattern that never dies, how it trapped Britain in the 1820s, how it nearly broke London in 1890, how it transferred Latin America from European influence to American control, and why China walked into the exact same machine in Venezuela. This isn't doom content, it's pattern recognition. And pattern recognition is how you survive geopolitical finance. Let us begin with the simplest question. Why would China pour so much into Venezuela in the first place? Because on paper, Venezuela looks like a strategic jackpot. The world's largest proven oil reserves, a government isolated from Western capital markets, a country desperate for cash, a perfect client state for long-term commodity access. Well, it looks like checkmate. But if you've studied this game for long enough, you know the trap is hidden in the phrase, desperate for cash. Because desperate debtors don't borrow to build, they borrow to survive. They will sign anything today to stay alive tomorrow. And creditors who think they're buying resources are often just buying time for a collapsing system. Now watch how this story escalates from opportunity to disaster, because this is where the pattern begins. Stage 1 always starts the same way. A rising power convinces itself it has found a risk-free strategic trade. The debtor is resource-rich but politically unstable. The West won't fund them, so the rising power steps in. The deal is framed as not a loan, but a secured resource contract. Oil for credit, copper for railways, mining rights for ports. It feels protected. It feels intelligent. It feels like the creditor outsmarted the system. China looked at Venezuela and saw 303 billion barrels of oil and a shortcut into America's hemisphere. The narrative was irresistible: secure energy, build influence, challenge U.S. dominance, create a new axis of power. But here's the deadly truth Stage 1 ignores. Venezuela's resource wealth was not the problem. Venezuela's ability to convert that wealth into stable cash flow was the problem. And that problem was structural. A country can sit on oceans of oil and still be broke if it cannot maintain production, manage infrastructure, or keep institutions functional. That's not an insult. It's a reality of governance and operations. And Venezuela's oil system was decaying long before the China money arrived. But Stage 1 makes creditors blind because it feels like destiny. It's not just finance, it's national mission. It becomes emotional, strategic. It becomes the story the creditor wants to tell itself about the future. And that story becomes the excuse to ignore every red flag. That's why Stage 1 is delusion. Not because creditors are stupid, but because strategy makes people justify bad economics. When you believe the goal is historical, losses feel temporary. When you believe you're building a new world order, you treat math like a nuisance. So the loans and projects begin, small at first, then bigger, then unstoppable. China expands. From early loans to larger energy for credit programs to infrastructure to telecom to deeper political support. And each step increases exposure and makes retreat harder. This is also why debt trap diplomacy is often backwards. In many cases, the debtor traps the creditor. The debtor receives money, assets, technology, and time. The creditor receives promises and discounted commodity shipments that depend on stability that does not exist. Stage 1 always sounds like partnership. But partnership language does not change insolvency. If the debtor cannot produce enough to pay, then the collateral becomes theoretical. Now Stage 2 begins, and this is where the cycle becomes irreversible. Stage 2 is the moment the creditor loses the ability to stop lending without admitting defeat. This is the expansion trap. It works like quicksand. The more you struggle to escape, the deeper you sink. Here's how it happens. First loan goes out, then the next, then another. New projects are announced, joint ventures form, production targets get promised. The creditor believes it's building momentum, but the numbers never meet expectations. The debtor underdelivers. The infrastructure doesn't fix the core problem. The governance doesn't improve. The economy doesn't stabilize. And then the creditor faces a choice: stop lending and accept the first loans are likely dead, or keep lending to protect the previous lending. That's where the trap snaps shut. Because psychologically, politically, and financially, stopping feels impossible. It would force a confession. We misread the country. We mispriced the risk. We got played. So instead, the creditor restructures. They extend maturities. They lower payments. They reduce rates. They create new facilities to cover old obligations. They call it strategic patience. In reality, it's loss management disguised as expansion. This is exactly what happened across history. British investors in the 1820s kept funding Latin American dreams while instability crushed returns. Argentina in the late 1880s was the safe emerging market until it wasn't. Then Britain was so deep, it risked taking its own banks down when the debtor cracked. Again, in modern terms, stage 2 often looks like this. The debtor keeps shipping commodities, but at discounts and irregular flows. The creditor marks it as repayment, but real value erodes quietly. The balance sheet says performing. The market reality says bleeding. That's why stage 2 is so dangerous. It doesn't feel like collapse. It feels like management. It feels like control. But it's actually the creditor being trained to accept worse and worse terms just to keep the story alive. And once stage 2 has locked, external forces become fatal. Because the creditor is now exposed to any shock. Commodity price drops, sanctions, internal political crisis, regime change, or intervention by a hegemon. The creditor is fully committed, but the debtor is still unstable. That's why stage 3 always arrives. It's not a surprise. It's the inevitable breaking point. Stage 3 is where the debtor stops being a problem and becomes an event. Something breaks. It can be oil prices collapsing. It can be internal unrest. It can be sanctions. It can be military pressure. It can be leadership change. The trigger varies. The outcome doesn't. At this stage, the debtor can't pay. Not won't pay, can't pay. The math stops working. The currency collapses. The state functions degrade. The creditor demands repayment and gets offered restructuring again. This time, the restructuring is not strategic patience. It's emergency oxygen. And the creditor accepts because there's no alternative. To refuse restructuring is to force default. To force default is to crystallize losses. To crystallize losses is to admit the entire strategy failed. So the creditor keeps extending the timeline and accepting inferior settlement, usually in discounted commodities or weakened assets. This is where Venezuela fits perfectly. A country with massive reserves but collapsing production capacity becomes unable to fulfill the original promise at meaningful value. Sanctions complicate flows. Operational decay reduces output. The debtor becomes structurally incapable of full repayment on fair terms. Then comes the geopolitical knife. The hegemon sees the opening and moves. Because when a state in your backyard destabilizes, external rivals' investments become vulnerable. And if the hegemon has military, financial, and corporate reach, it can reshape the new settlement landscape. At this point, China's position becomes the same as every creditor empire before it. You can protest. You can argue international law. You can file arbitration. You can demand treaty protections. But enforcement is the only language that matters. And enforcement requires power where the assets sit. This is why stage 3 is the realization moment. The creditor realizes it has been paid in discounts, it has been trapped by sunk costs, and it has no leverage when the final turn arrives. Stage 3 isn't the theft yet. It's the helplessness that makes theft possible. Now, stage 4 begins, and this is where the transfer completes. Stage 4 is the part nobody wants to admit because it sounds too brutal. But history is blunt. Stage 4 is where assets transfer to the next power at fire sale terms. And the original creditor gets pennies or nothing. The mechanism is simple. A new regime emerges, or an external power stabilizes the situation on its terms. Contracts get renegotiated, joint ventures get restructured. Infrastructure gets repurposed, permits get reassigned. Who benefits? The power that can operate locally and enforce outcomes. The original creditor becomes a spectator. This is why Xi calls it theft. Not because the money literally vanished into smoke, but because the control over what China paid for is slipping away. And in geopolitics, control is value. If you build roads, pipelines, refineries, telecom networks, and you lose control of the political space, then your investment becomes someone else's leverage. Now zoom out, because Venezuela is not the whole story. It's the signal. The signal is that Chinese debt can be restructured without real enforcement when the debtor collapses or the sphere shifts. That signal travels fast. Other borrowers see it. They learn. They calculate. and they start asking for the same terms. This is where the next dominoes come in. Whenever a major creditor takes a visible loss, other debtors test the boundary. They demand relief. They threaten default. They negotiate harder. They delay longer. And the creditor is forced to choose between admitting systemic losses or pretending everything is fine with endless restructuring. That's why Belt and Road stress is not about one country. It's about portfolio dynamics. Multiple debtors under pressure at the same time create a wave of renegotiation. And in waves, creditors lose pricing power. They lose leverage. They accept worse terms just to keep the loans alive. So what should you take from this as an investor or observer? 1. Watch creditor behavior, not headlines. When a creditor starts extending terms widely, that's not strength, that's the trap expanding. 2. Watch hegemonic enforcement signals. When the dominant power asserts its sphere, foreign investments inside that sphere become politically discounted. 3. Watch which companies get access after the shift. Permits and exemptions are the real scoreboard. And here's the last truth that matters most. The money never disappears. It transfers. From creditor to debtor. From builder to buyer. From the one who paid full price to the one who buys after the collapse. Stage 4 is not the end. It enters the beginning of the next cycle, where distressed assets are acquired cheaply and influence is rebuilt under new terms. China's Venezuela bet is a textbook case of the 4-stage empire-creditor cycle. Delusion. Trap. Breaking point. Transfer. It is repeated for 200 years with different flags and different slogans, and it's repeating again because the structure didn't change. So if you want the real lesson, it's not China is weak or America is evil. It is that creditors without enforcement power inside the debtor OS sphere are playing a game designed to humiliate them. The spreadsheet is not sovereign. The Navy is. And if you understand that, you stop being surprised. You start spotting the next domino before it falls.